For years, I thought investing was a loud, chaotic game played by men in suits. I imagined flashing screens, constant shouting, and an unspoken rule that if you weren't glued to the markets every second, you were already losing. I thought I needed to spend hours analyzing balance sheets, memorizing financial jargon, and chasing the next big thing before everyone else discovered it. I believed investing had to feel stressful to be effective. I was wrong. The most powerful thing I ever did for my freedom wasn't learning how to trade, it was learning how to own. That shift changed everything. I traded the question, which stock is next, for a far more powerful one. Which system will build my wealth while I sleep? I walked away from the chaos of overtrading and embraced a much simpler strategy: index funds. Today, I'm going to show you exactly how I built my portfolio and how you can do the same to secure your future without sacrificing your time or your life energy. I chose index funds because I value my time as much as my money. An index fund is simply a basket of stocks designed to track a specific market segment. Instead of trying to pick individual winners, you buy a slice of the entire system. For example, the S&P 500 represents the 500 largest, most influential companies in the United States. These are companies you already interact with every day: Apple, Microsoft, Google, Amazon, Visa, Johnson & Johnson. When you invest in an S&P 500 index fund, you are not guessing which company will win. You are betting on human progress itself. The myth of the expert. Here is the reality that completely reframed my thinking. Over 90% of professional money managers fail to beat the S&P 500 over a 15-year period. Let that sink in for a moment. These are people with Ivy League degrees, Bloomberg terminals, inside access, and massive teams of analysts. And still, most of them lose to a simple, boring index. So I asked myself one honest question. If the experts can't consistently beat the market, why should I sacrifice my evenings, my weekends, and my mental energy trying to do it? That question set me free. By investing in an index, I stopped betting on a single horse and started betting on the entire track. I stopped searching for winners and chose to own the economy itself. Ownership is quiet. Ownership is patient. Ownership doesn't need to prove anything. This is exactly how I set it up. Building a portfolio shouldn't be about complication. It's about refinement. I follow a 4-step process to build my financial fortress. Step 1. Choose your sanctuary, the brokerage. Your brokerage is your financial home. It should feel solid, stable, and, dare I say, a bit boring. You don't want a platform that treats your life savings like a video game. I opened my account with a low-cost, reputable provider like Vanguard, Fidelity, Charles Schwab. These institutions have survived wars, recessions, crashes, and market panics. They are not trying to entertain you. They are designed to protect you. Avoid platforms that feel like games. Confetti is not a financial strategy. Step 2. Select your core funds. The foundation of my portfolio is very simple. I put the majority of my wealth into total market and S&P 500 funds. Here are the specific tickers I use and recommend you research. VOO or SPY. These track the S&P 500. They give you exposure to the biggest engines of the U.S. economy. VTI. This tracks the entire U.S. stock market. Thousands of companies ranging from the giants to the small, up-and-coming innovators. VXS. This provides international exposure. It ensures that if the U.S. market stays flat while Europe or Asia grows, you still benefit. You own a piece of the global economy. With these few funds, you instantly own thousands of companies across every industry, country, and currency. You are diversified by default. There are no constant decisions to make, no emotional trading, and no second-guessing your picks. Step 3. The expense ratio check. This is where most people unknowingly sabotage themselves. Every fund charges a fee called an expense ratio. It sounds small, maybe 1% or 0.5%, but over decades, it is a silent wealth killer. My rule is non-negotiable. I only buy funds with an expense ratio below 0.10%. For example, VOO has an expense ratio of 0.03%. That means for every $10,000 I invest, I pay only $3 per year in fees, not per month, per year. High fees don't look dramatic today, but over 30 or 40 years, a 1% fee can quietly steal hundreds of thousands of dollars from your future self. This is not about being cheap, it's about being intelligent. Step 4. Automate the process. This is where discipline becomes effortless. I set up an automatic transfer from my bank account to my brokerage every month. I don't wait to see what's left over at the end of the month. I don't negotiate with myself. I pay my future self first. Automation removes emotion from the equation, and emotion is where most financial mistakes are born. By the time I even think about my paycheck, the seeds of my future wealth have already been planted. What this looks like in real life. Let's make this tangible. Imagine you decide to invest just $100 per month. That's roughly $25 a week. The cost of one modest indulgence you probably wouldn't even remember a month from now. If you invest that $100 into a standard S&P 500 index fund, which has historically returned around 10% annually, something remarkable begins to happen. Over 30 years, you physically contribute $36,000. That's it. But because you gave that money time, because you allowed it to compound, your account grows to nearly $200,000. That extra $164,000 did not come from working harder. It did not require more hours, more stress, or more sacrifice. It came from one decision: to let time do the heavy lifting. That invisible engine is compound interest. It is the only force on earth that allows you to grow wealth while you sleep, while you travel, or while you are fully present with the people you love. You don't hustle for compound interest, you allow it to happen. Now, how I think during market drops. Well, the market will fall. Let me say that again. The market will fall. That is not a flaw in the system. It is the price of admission for long-term growth. When headlines scream and charts turn red, I don't panic. I don't sell. I don't wait until things feel safer. I see discounts. Because I have a long-term vision, a 10% or 20% drop is simply an opportunity to buy more ownership at a lower price. Volatility is only dangerous if you need the money tomorrow. If you're building for decades, volatility is fuel. This is why I rarely check my portfolio. Daily checking is for people who are anxious, not for people who are invested. I am an owner. I review my accounts once a quarter, not to react, just to observe and admire the slow, steady progress. Then I close the app and return to my life. Wealth is meant to support your life, not replace it. What financial independence really means. Financial independence is not about greed. It's about knowing that no matter what happens, economic shifts, career changes, or global uncertainty, you have built a system that can sustain you. It's about the power of choice. The choice to say no to a toxic work environment. The choice to rest when your body needs it. The choice to be present for your family. The choice to walk away from what no longer serves you. You don't need to be a math genius. You don't need insider knowledge. You don't need perfect timing. You only need two things: the discipline to start and the grace to stay the course. The journey from consumer to builder begins with a single, simple action. You are not just saving money, you are buying your future freedom. Take that first step today. Subscribe to Smarter Finance for practical strategies and the blueprints you need to transform your savings into a self-sustaining wealth machine.